Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line's State of the Economy podcast series. This is the fourth of the podcast focusing exclusively on the equity markets, and this series is coming to you regularly every month. Bringing to you insights from market experts is your host, Parvatha Vardhini. I am the editor of BL Portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Anuj Kapoor, MD and CEO, Private Wealth and Alternatives Asset Management at JM Financial. Mr. Anuj Kapoor is a chartered accountant and has over 26 years of experience in financial services, having worked in UBS Securities India, Barclays Bank, GE Capital, Ernst & Young, and Arthur Andersen. Hello, Mr. Anuj Kapoor. Welcome to the podcast on markets.
Hi, Vardhini. It's a pleasure being here.
Great, sir. It's an interesting time for the markets, Mr. Kapoor. I've been doing this podcast for the last 4 months and quite interesting. Recently, after the volatility, since touching a peak of 20,000 plus points in mid-September, the Nifty has touched a new peak on Friday. So what do you expect from here on for the markets?
Yeah, so markets actually came off the highs on the back of rising yields in the US and the geopolitical tensions, most recently the ones in West Asia. However, as we look at things today, I do think there's limited impact of the conflict in the Middle East. It seems like the impact has been contained, especially given the ceasefire. I think the biggest collateral damage for India was the oil prices that went up, which seems to have stabilized as well. Yields in the US have also come off significantly from the highs of having crossed 5% to more recently hovering around 4.4%. I think reacting to these two positive developments, along with a resilient earnings outcome in the recent quarter, markets have rebounded. And we do see or expect this uptrend to continue in the markets as the earning expectations is actually quite good. If you look at the PE ratios for the Indian markets, they are at about 20 times PE 1 year forward. Long term has the averages have been around 20 to 21 over the last 10 years. And hence, I would not say that the markets are very, very expensive given the long-term averages of the Indian market. While FIs have also become net buyers recently, I think the domestic flows are such, they have been so strong and resilient. To my mind, the single most important risk for Indian markets is the political risk if BJP does not come back to power. And that's a very remote possibility. Otherwise, I do believe that we are in for an extended bull run in Indian markets.
Okay. So are you of the view that interest rates will remain higher for longer? So this is what has been echoing in a lot of corners. So do you agree with that view? Is the recession in the US a possibility?
See, inflation in the US has been trending down at least, and it's sort of becoming more range bound. But at the same time, economic growth has remained quite resilient, especially in the labor market. So I think it's expected that the slowdown, as the effects of rate hike percolate in the system, the slowdown may happen, but it's expected to be a soft landing. The US central bank is very, very data dependent, as we've always seen. They would like to see inflation to come down sustainably along with much more stable labor market before they take any rate cut action. So if we look at the market expectations also, we expect Fed is expected to cut rates from mid-24 onwards, and there'll be a 50 to 75 bips rate reduction in the calendar year 24. I would tend to agree with this consensus view unless there was some growth shocks that came along the way. And with the incoming data, I think the consensus view is that, as I mentioned, there's a soft landing that means inflation coming down towards the target range should happen without any major sacrifice in growth. And I don't see a recession as such in sight.
Okay. So you are saying that, say, probably by the second half of next year, until the second half of next year, at least the interest rates are expected to remain at current levels. That's what you're saying. And then the rate cut cycle is expected to begin.
That's right. And we've seen traditionally the Indian regulator being extremely conservative, and that has actually played out quite well for India. So on similar trends, I'd expect that, while Indian inflation has remained within the targeted range, not as per the sort of expected rate or the targeted rate for the Reserve Bank of India. But growth has remained resilient and we have a healthy external account balance as well. So having said that, I do see limited scope for any rate reduction in India before we have a clear guidance from the Fed.
Okay, I get it. So you're saying whether it is the US as well as India, say at least for the next 6 months or so, you expect status quo and then you expect rate cut action to begin, depending on what happens in the US. That's what you're saying.
Precisely.
Okay. So you know that Indian market is interlinked with the US markets, like how you just said, but how much of an impact? So because we do have our local domestic macros looking very good, and then there is this election uncertainty as well. So how much of an impact would any action, be it a rate cut or a postponement of a rate cut in the US, how much of an impact do you expect on the Indian equity and debt markets?
The Indian fundamentals are extremely robust. Economic growth is amongst the highest in the world. There's a healthy external account. We're seeing double-digit earnings growth over the next couple of years at least. And the valuations are not overtly expensive. I would see limited impact of higher rates for longer periods of time because the domestic fundamentals are very, very strong and domestic flows we have seen are supporting markets in a big way, even when FPI flows have remained lower or weaker. However, in case of a recession, if it were to play out, export-dependent sectors may see challenges. But I think domestic consumption and investment sectors are likely to remain least impacted even in such a scenario because Indian domestic consumption, domestic flows are quite resilient and they shield the impact of such extreme cases as well.
Okay. I had this question. You already mentioned about FPI versus DII flows. So I had this question. So, although there seems to be inflows, a lot of, recent reports. So one from a global investment bank or a brokerage and one from a local brokerage firm, they came out with this report which said FPI ownership in Indian equities is at its lowest in at least a decade. So, and, DIIs have been cushioning the markets to a certain extent. So, what is the, would you say that, FPI ownership doesn't matter anymore? Or do you still look at India as being FPI dependent and, FPIs would pull money out of Indian equities when they find the US markets more favorable?
Sure. I think the flows towards equity markets in India have just started to happen and there's a long way to go. Yes, when there is a flight to safety and or US equities or Western equities look attractive, there is an immediate pullback from the FIs. But I'd say today, the way markets are in India, the domestic flows more than amply shield the impact of such a shock with the FIs withdrawing. So clearly, Indian markets are much less dependent on FIs. Having said that, I think we do expect in the longer term, FI flows to be quite robust for India. I think a key factor today clearly is, how the mutual fund asset growth is progressing. If you look at the mutual fund assets to GDP ratios, which are around 16 to 17% in India versus a global average of 74%, there is still a very long way to go. Okay. Likewise, in equity, AUMs, India is at around 6 to 7% of GDP versus a global average of around 33%. So this will give you a good sense of, how much headroom there is to catch up. And as financialization of incomes continues to happen in India, I think we're still underestimating the power of domestic investors.
Now, there is, along with India, there are a host of countries which fall under the emerging markets umbrella. So one key economy is, of course, China. I don't know whether you call it as an EM or a developed nation, but in your view, how China moves is very important for Indian markets per se. So there is a slowdown in China. So how do you view the slowdown and in what ways is this slowdown in China good or bad for the Indian economy as well as the Indian equity markets?
Yeah, I break down the China slowdown really into two aspects. One, clearly Chinese slowdown is good for global as well as Indian economy because it clearly has subduing impact on the commodity prices, which has in turn helped in lowering the inflation globally. From an India perspective as well, a struggling China as good as Indian markets would be seen as an alternative to some extent by global investors. and there'll be more capital getting allocated to Indian markets. Even in the real economy, some of the manufacturing outsourcing on a China plus one perspective would flow into India as it would to some of the other countries like Vietnam and Taiwan. However, I'd like to caution that a prolonged slowdown in China could slow down the world economy as a whole, because China is such a significant component of the world economy today, which directly or indirectly will have an impact on the Indian economy and markets in general around the world, because you are living in a connected world still. And you can't just shy away from a significant component of the global economy slowing down on a prolonged basis. So that, I think, is not going to be good.
Coming to other emerging markets, so if you see the MSCI India versus the MSCI EM, now the Indian index is trading at a much higher premium to the EM index. So how do you expect India to fare in the coming months or in the next 1 year vis-a-vis other EMs? Do you expect the outperformance to continue?
I'd say India is very uniquely placed in the emerging market pack currently. Apart from the macroeconomic factors that we mentioned earlier, which are favorable versus the rest of the EM pack, India has the advantage of a healthy democracy, a large domestic consumption base, very favorable demographics, the rapid financialization of savings that has begun to happen, which are all positive factors contributing towards the long-term growth of the economy. We have entered a phase, I feel, where it's a secular, long-term, strong run for the Indian markets. As I mentioned, political risk continues to be there, albeit very remote. Otherwise, for the next 10, 15 years, I do see India being very uniquely positioned. And while, as I mentioned earlier, versus long-term averages, Indian markets may not seem very expensive versus emerging markets, there is going to be a premium because India is a large market. And hence the liquidity that it offers and the kind of options that it offers versus some of the other peers in emerging markets would be much more varied and broader in the Indian market. And secondly, I think the valuation premium that India commands over the broader EM pact is also justified given the fact that India provides a lot of visibility on earnings versus its peers.
So you did speak about the current earnings season, which has just concluded in India. So what was your reading of the corporate earnings? If you break it down into sectors or key companies, and what is your growth expectations for FY24?
Sure. I think it's been a very good quarter in terms of earnings performance, where Nifty earnings were up by about 27% year on year, and that beat the estimates. This was mainly attributable to improvement in the margins on a year-on-year basis, while sales grew by about 5% quarter on quarter. For the full financial year 24, Nifty earnings are expected to grow in high teens, and this could moderate down to about low to mid-teens for FY25 to 26, which still augurs very well from a prospective basis.
And so there is you don't see any big downgrades after the first half?
No, not really. I think we are trending positive, and some of the manufacturing sectors and some of the infrastructure related sectors are seeing a lot of investment going through. So I do see the earnings momentum being sustained.
Okay. That way, there's a lot of talk in the markets today about, mid and small caps being expensive, having had a very strong rally, whereas, there's a lot of opportunity in large caps. So would you subscribe to that view? Where are the opportunities today in terms of market capitalization? And number two, also in terms of sectors, you did mention one or two sectors, but, your broader take.
Sure. I think we've seen a lot of momentum in some of the mid to small cap sectors and more mid to small cap stocks in India lately. And whereas the large cap has not really rallied or performed over the last couple of years, even after improved fundamentals. So I do see a lot of value in some of the large cap stocks. Nifty 50 valuations, if we look at it, are trading around 10-year averages, which I think is reasonable, as I mentioned. But the value in large caps versus small to mid caps today is seeming, the risk versus reward trade-off is seeming favorable. Having said that, there will always be opportunities for active stock pickers as the universe in mid cap and small cap stocks is quite high. In terms of sectors, I would say companies that are riding on the narrative of sectors like defense, railways, manufacturing, those have seen good pickup and profit booking has happened in some of these sectors. So we do see relative better value in large caps today. Because these valuations in some of these sectors that I've mentioned have become expensive now.
Okay. So you are saying that for the sectors that are in vogue, you should, investors should probably wait for a correction for the valuations to cool off a little bit. That's what you're saying?
That's right.
The runway is long, the valuation is not right.
Yes, absolutely.
Okay. In your current role, you do a lot of business with HNI. So how do they view the markets vis-a-vis, a normal retail investor? What are the differentiating factors for these high net worth investors?
I think the larger ultra high net worth and family office investors have today become much more formalized in terms of setups and have hired some quality talent as well. While the number of such family offices in India would perhaps be in the hundreds, but they do behave like institutions, and sometimes in primary issuances as well as in the secondary markets, we do see them come in a big way and support new issuances. So we actually have a dedicated group catering to such high net worth individuals as well as family offices, and we give them an institutional status and service them like institutions, quasi-institutions.
Okay, so would that mean that their risk-taking abilities are higher and they understand risk better than retail investors?
That's right. I would categorize them more towards institutions rather than retail investors because they are formalized setups. They have a proper investment and risk advisory mandate there, which are board approved in a lot of cases, and they have access to quality research. And hence the decision-making process is also much more nuanced and informed.
Okay. A lot of wealthy investors, I'm sure they look to alternative investments, for diversification purposes. So what are the popular alternative products that for Indian investors on offer, and how do the returns compare with the traditional ones?
We live in very uncertain times today, and these times are also very, very dynamic. And hence the need for alternative investment avenues, which sometimes have a lower correlation to public markets or have lesser volatility, is the need of the hour. And increasingly so, these are becoming of interest to HNI investors and family offices. So the emergence of vehicles like alternative investment funds or AIFs, REITs, InvITs, has broadened the investor base for alternative assets. We've seen a huge spurt in growth in AIFs, something to the tune of about 50% CAGR in the last 5 years. So I do believe that there is a lot of attractive opportunities in alternatives across credit, across equities, and we closely continue to evaluate them. We've been working on various strategies, including a performing credit fund, a special situations fund, a fund on public listed equities as well. And in times to come, focusing on other asset classes like real estate, pre-IPO situations, private equity, is how we would like to differentiate ourselves vis-a-vis competition. And I think some of these offerings, while playing to our strengths, are being increasingly appreciated by clients for the uniqueness, for the well-structured solutions that we offer, and for the right, most importantly, risk versus reward balance.
Thank you so much, Mr. Anuj Kapoor, for joining us in this podcast today. I'm sure that the listeners did have a lot to take away from this conversation. Thanks once again. Thank you.
Thank you.
Yeah.